the role of debt in purchasing homes. So maybe Stephanie, you'd like to talk a little bit about that?
I would say like I think our main question we have, right, Steph, is that in terms of home purchases, right, in your experience, right, the role of that, how much of a role does it play in most people that you see in your line of work? Like in terms, because like in terms of like things like equity and investing, right, it's very clear that most people who invest in stocks and crypto, right, we don't actually use leverage. Whereas in home purchases, I would imagine, right, that most people take on loans. So in your experience, right, uh, how big of a role does that play when it comes to home purchases?
From my experience, I would say it's very big. Of course, as for property developer, they would love having cash buyer, but the reality is, most people, I would say 99.5% of people really use loan, really need to have mortgage to buy their house.
So that means like for majority of the people, right, without a mortgage, they cannot buy a house or home.
Yes, or even if they have the money to do so, they don't want to do that. And especially, I mean, this is kind of like insider thing lah, especially for those that really want to cash buy, right? There's a reason why they want to cash buy. And it's usually is 50%. It's not because of a very good reason, like maybe like, money laundering and stuff like that lah.
Yeah, that makes sense.
Mm.
I mean, where all that cash is coming from, right?
Yes.
So
Well,
so in that sense, right, the banks are like super important because like everyone will flock to their banks and get like a loan just to buy a house, and therefore like all the interest rates and everything, it's like super important in that sense.
now I would say
Yes.
like Steph, I guess the question is, right, how would you like advise, right, a person, first time buyer, let's say I'm fresh in the market, I want to buy a house in, let's say how what is the, I would say, right, as a buyer, right, let's say there's two type of buyers. The first type of buyer, how would you advise the first type of buyer to go on that, right, when it comes to buying a house for family purposes, meaning I want to have a family? And then the second type of buyer is I want to buy a house, right, for investment purposes.
Mm.
How would you at best advise, right, these two group of buyers, and what are the differences?
Actually, for those that are buying for homestay, of course, you want to reduce paying as much interest as possible. So I think one of the options for them is to consider a full flexi loan where, you get to put more money into your current account to save on the interest paid in the long run as well lah. So you get to pay down your debt in a shorter amount of time, and also lesser interest paid to the bank. As for investor, I think it's more different where you want to really maximize that, which is like maybe you want to have a longer loan term so that you can reduce the amount of installment you pay per month, especially for those that are renting out. And then because you want to get more cash flow, meaning lesser money goes to the installment, meaning more money coming into your own pocket. Yeah, I think that's the difference lah.
But like
So,
going back to the investor group, right?
Mm.
There's also usually two types of investors for within the property market. One would be going for the capital appreciation of the home. The other one would be more going for like a rental or an Airbnb model, kind of like yield investors. Is
Yeah.
that true? And if how would you advise like these two sub different kind of category kind of investors in taking on their debt?
I think same goes to any sort of in any type of investor. Most investor want to reduce their monthly installment as much as possible, and even for capital appreciation, like let's say if this person aim to resell it after say 10 or 15 years, the person, because with lower cost per month, you get to sell it off, you get to own the house and then sell it off for a profit. So it really depends. Unless the person really want to save on the lending cost, then the person may want to consider also paying lower interest as possible, like maybe opting for more installment payment per month, or or a longer or a shorter loan period. So it really depends ultimately what the person wants. But mostly want to save on the cost per month. So like mostly will opt for a longer period and any way to lower down or minimize the installment per month.
So that stems from the interest rate of the bank, right?
Yes.
Does it?
Yeah.
Interest rate of the bank, the terms that the bank give you. So, for example, if let's say, actually, I did a quick tabulation because I think we were having a conversation about how the OPR in Malaysia is increasing, not just in Malaysia, in Singapore as well. Because I just got a friendly reminder from my bank that they're going to increase the rates. It's quite sad, but oh well. But thankfully, my terms are fixed, so I don't really care. But I would say that in Malaysia, right, like Stephanie, I think you mentioned a very critical component when it comes to like debt, the rules of debt, and that is when you take on debt, right, and then you're focused on like the monthly payments, right, that interest rates does play a very big role in terms of your net investment return, right? Because let's say I actually did a number quite quickly of every single 1% increment, right, of your interest rates, right, actually does sort of impact cash flow outlay. It increases by about 10 to 15%. In the next restructuring. So, for example, if let's say your rental, right, let's say your mortgage, you're paying like 2,000 ringgit. Then, if the interest rate goes up by 1%, the next time it resets, it is going to go up by about 250 ringgit per month.
Mm.
And then if let's say it increases by 3%, that's additional 750 ringgit a month, which is close to a 30% cash outlay, right? So, coming back to this, right, I you see the main challenge I always have when it comes to property, right, is that a lot of people say that renting is a good way to play it, but in terms of practice, right, Stephanie, do you feel that there's still value add in this particular way to invest money in property? A lot of people, they say that it's good to buy a house, then you rent them for rental income, right? But in your experience, right, in terms of practice, does this still work in practice? Like, meaning I buy a property, I take out a loan, right, and then let's say I borrow 90%, if I rent out the place, do you still think that it's a wise decision to play the rental game?
Is it still profitable?
Yeah.
I think currently for now, it really depends on the property that you select. I think it's very important because, like I mentioned in my previous pause, right, you can't just go into a show unit and then choose a property and then you wait for it to be rented out. You wait for someone to come and rent it. I think investors need to take a more prudent approach, which is to look at several indicators before selecting and confirming to buy that property, to ensure there's really demand for the rent in the area, and also to be able to fetch the desired rental income that they want, and also be willing to also put in the work. So from my experience, because I also have a unit and for rent as well, and doing that, I really learned that it's not as good as people say lah, and it's not as easy also. I also do get worried. What if this year, by the time the tenancy ends, will the tenant renew again? So I have that kind of worries. And will the tenant spoil my furniture and stuff like that? And then for the next new tenant, will I still be able to rent out at this price? Because in the neighborhood, there's so many people also renting out the unit. So I think there's several indicators that can be used as guidelines to reduce that kind of risk, that sort of uncertainty, especially for investor or people wanting to get into the property investment space.
When you
I love
say
that.
data and like all this information and statistics, right?
Mm.
I saw like on your post, there was a specific website for Malaysia that you actually go to for all these statistics, right?
Yes, it's NAPIC, the NAPIC website, but there's also JPPH. All these are on property information. So JPPH is like Valuation and Property Service Department, and the NAPIC is also like the National Association for Property Information Center, something like that, where you get to have a comprehensive overview of the property. How is the property sector really doing? And they even dive into like specific states. Although sadly it's not like by area, because there used to be bricks.my, which is now being acquired by Property Guru. So Property Guru, from time to time, they also do share valuable insights as well on how's the property market doing. so that property buyer or investor can make a better informed decision as well.
Some
So you see, guys, this is why we have Stephanie like on the show, because like like seriously, to find a person, right, who's like willing to share all of whatever she says is so hard to find it inside the marketing, the flood of marketing when it comes to like property selling. Because every single time, right, they always tell us like, you can buy this right now, it's brand new, etc. It's very good. They always like sell you a very rosy picture. But I think in practice, what Steph has mentioned, right, is that it's not as easy as most people think. And whatever you have described, Stephanie, that's exactly right what me and Ryan have done in our own investment space in the equity and crypto sector. Like before we go in very like deep into an idea, or before we even put money into an idea, right, we actually do a shit ton of like research and analysis to make sure that whatever we're buying is like good investments lah. So I guess like guys, RA21 podcast has always been pretty much fundamentally an investment podcast, right? But I guess like that's why whenever like people always ask me like whether or not real estate is good or bad, I always say it ends of the day, right, it always goes back to like what are you really interested in and what are you keen in? Because whatever Stephanie has mentioned, right, is that she has done the homework to make sure that, the area that she's considering to buy, and then she even talked about like various risk factors, which exactly are what, any equity investor would do before they buy an investment. Like before I even like buy into things like Bitcoin, Ethereum, like things like that, we actually do need to do due diligence, and actually like think about, potentially, Stephanie mentioned the potentially like you need to think about your debt structure, the term that you buy, then the interest rate increment, and then what Stephanie mentioned about interest rate going up, then whether or not you can afford, in finance, this is what you call sensitivity testing, because that's really like the only way to like do this type of projection, right? Because I'm inside personal finance, so every single time when a client comes to me, right, and ask me, right, whether or not they should take this loan at this particular like take this loan, for example, they want to take a loan, right, that is like this debt structure 20-30 years, right, and then they are concerned about the interest rate going up. The right way to do it, right, if you're a competent consultant, is to do an interest rate sensitivity test, meaning, right, you basically just do a projection, of the payment, and then do a worst case scenario. Let's say, okay, the interest rate I'm borrowing now is 1%. Okay, what if it's going up to 5%, 6%, 7%? Then you do that, right, and then you basically look at the projection of the end value of the asset. Let's say I buy 1 million, now the interest rate 1%. And then I foresee in 25 years, maybe I can sell for 1.5. If the interest rate right now is 1%, 25 years I sell 1.5. After I tabulate all the payments, am I still profitable? And at what point, right, in the interest rate, once it crosses that particular point, 4 or 5%, then I become a net loss, right? So you see, the thing is, right, the thing is, I find that people tend to oversimplify investing, right, and debt, right, when it's actually not as simple as the salespeople like to say lah. Because end of the day, the sexy part is to sell you a dream. The unsexy part is to actually take a step back, right, and then do the numbers, the Excel, right, and basically like do all this like interest rate tabulation, and actually wonder whether or not, right, can it, number one, if you intend to sell in 20 years, right, whether or not it can actually hit your price. And then you need to have a level of foresight to see into the future, like what Stephanie mentioned, right. She's worried about like whether or not after the tenancy lease is up, whether or not she can get a price, and she's also concerned about competitors. These are things which we that investors are in equity we also think about, like 10 years from now, whether or not like like for example, if I invest in Walmart in 2010, right, I wonder, I also need to think like in 2020, right, will Walmart be destroyed by Amazon? These are things which we think about, and it all stands back down to how much do you like the investment class that you like? Because if you do like it, right, usually what tends to happen is that you get pretty good insight in that particular asset class. Yeah, so I think like because I think also the reason why we have Steph here, right, is because unlike the equity space, and the crypto space, right, we don't usually use margin, whereas for property, right, when you invest money, the likelihood, right, that you need to use margin and borrow from bank is quite high, because most of the time, in order for you to get inside property, no matter which like country you're from, you tend to need to borrow. Because I would say that even as what Steph mentioned, right, even if I have clients who have money, right, most of them will generally borrow money to buy a house, even if they are able to like fully pay. Because end of the day, what really matters and what they want is the liquidity. And then I would say also add in, right, that the richer and wealthier you are in the terms of hierarchy of wealth, beyond a certain point, once you become classified as a sophisticated or high net worth investor, right, the bank actually allows you, right, to borrow money, not in your home currency, but in other currencies as well. And that becomes very sophisticated. So it's another level of debt, right, which you never really see much talk about, right, in terms of the general mass market population or personal finance. Because if you go to like the high net worth and then you go to a private banker and you talk to them, you're talking about family offices, the loans that they give you is not even like, for example, you buy a property in Malaysian ringgit, right? Your money you borrow might not be in Malaysian ringgit. You might actually borrow in Japanese yen, or you borrow in like Swiss franc, or you borrow in other like currencies. And basically the reason why you do that is because the currency is either stronger, it's either weaker, then when you pay off, right, you're actually making money double dipping. Right? You make money from the currency exchange, and you also make money from the property, and then you also make money from the interest rate. Because if you borrow, let's say, money from Japan, right, at one point, Japan, the interest rate was negative. Then if you borrow money from Europe, right, at one point, the interest rate in Europe was negative. You get what I mean?
Yeah,
So
it's leverage on top of like the foreign exchange.
yeah, so I would say that the main reason why I share this story is quite simple, because it goes back down to the fundamentals of asset and liability, right? A lot of people always think that, liabilities is very shallow. I only have credit card, I only have personal loan, I only have mortgage loan. But the fact of the matter is, right, if you actually understand that and you know how to use it, what you're going to realize is that the levels of sophistication that goes into debt structures can be so crazy, right? It's really very sophisticated, where it even goes to the extent and the extent, right, where you can borrow, let's say, Japanese yen, right, and then you pay interest. Even the interest itself can be swapped. Let's say, for example, instead I don't want to pay the interest rate that the Malaysian OPR is giving, I want to pay interest rate on Japanese yen. Do you know that there's also financial instruments that allow you to do that? They call it interest rate swap. So
Wow.
like I'm just giving you some insight into like the super like high level of finance and what these like bankers they like to like package all these style of loans. But the fact of the matter is, right, before you can even get there, you always goes back to the fundamentals of no matter what instrument you take. Be very prudent with your purchase. Be very sure what you're buying, and make sure that the things that you're doing, right, it needs to work in your favor. Because I would say I always have a mantra to all my clients. No matter which states of life come out, my mantra when it comes to dealing with financial institutions, especially bank, if it's too good to be true, okay, it often is. Okay, you need to learn how to navigate the financial space, and if you cannot do it yourself, honestly, you are better served, right, if you can find a professional who do it for you. Like, for example, I give you a very good example. Like, for example, when you have legal issues, you go to a lawyer, right? So if you have a financial question and you are not very sure of yourself, hire an accountant, hire a person who's good in this. Because end of the day, when you pay for this type of like professional advice, you're really skipping like 10, 15, 20 years ahead of your peers, right, who are just learning about this firsthand. So sometimes, right, it does make sense for you to pay for this type of like advice, because if you cannot do it yourself, right, sometimes it makes sense for you to hire a professional to do it. Yeah. So coming back to the homes and debt, right,